All right, welcome back. Today we're looking at a really strong, pretty contrarian bull case for Opendoor Technologies.
Ticker open. Yeah.
Right, open. And the core argument is that this shift to what they're calling Opendoor 2.0, which is all AI-powered, is going to justify a price target of like $10, maybe more.
Which is a huge jump from where it is now, around 580.
A huge jump. Now look, the analysis is high energy, it's structured well, it really nails the catalyst, this whole idea of moving from a simple house flipper to a data company.
And it even calls out some technicals, like that 5 to 550 support range, which is a nice touch.
Exactly. So let's just jump right in on how we can take this from a really compelling story to, an absolutely conclusive investment case.
Yeah, the report does a fantastic job of setting up the narrative. You feel the conviction, that whole Opendoor 2.0 revealed theme. But, conviction alone doesn't really move the needle for serious investors.
So the theme running through this is the AI. They call it the secret weapon.
And it is. But to unlock that $10 valuation, you have to prove that the change is real, that it's repeatable, and most importantly, that it's measurable.
Okay, so that leads right into our first point. To elevate the thesis from a compelling narrative to an unassailable investment case, the analysis report needs to provide measurable, operational evidence of the AI's effectiveness in reducing risk.
Exactly. It labels the AI the secret weapon, the game changer for pricing, for avoiding bad inventory, but these are just labels right now.
They're assertions, not proof. It mentions that unit economics are stabilizing because of the tech, but the actual mechanism, it's still, a bit vague.
That is the absolute core of the problem. I mean, how do you quantify revolutionary when it's all happening inside a proprietary black box? The entire bull case hinges on this AI reducing the historical inventory risk.
Which has always been the company's biggest liability.
Always. So we have to translate that algorithmic claim into something you can see and measure. The suggestion here is simple. Strengthen the link between the tech and the financial outcome. Use specific operational metrics that show the AI's impact.
Precisely. So instead of just saying, the AI reduces risk, the analysis needs to project some specific, tangible improvements. For instance, what's the most important thing the AI does?
It predicts the house's value.
Right. So quantify the change in the pricing accuracy delta. The difference between Opendoor's AI price and the final sale price. Compare the Opendoor 1.0 models to the new 2.0 models. That would be immediate, measurable proof.
And why is that so crucial? Because that delta, that little number, feeds directly into unit economics. If the AI is more accurate, the price they buy at is closer to what they'll eventually sell for. Less volatility, less risk. And building on that, if the AI makes pricing faster and more confident, then inventory turnover has to get better.
It should accelerate the whole transaction.
It has to, because every single day an asset sits on that balance sheet, you're tying up capital and you're accumulating market risk. Faster turnover just means lower risk and way higher capital efficiency.
And we've got to connect this directly to the bottom line. The analysis mentions a $90 million quarterly loss. You need to show how a specific, even a hypothetical percentage increase in AI pricing accuracy translates directly into reducing that cash burn.
Yes, that's what links the tech directly to the P&L statement.
It makes the AI lever not just a buzzword.
Absolutely. The report could even model it out. Say, a 15% improvement in pricing accuracy reduces the required profit margin by 50 basis points. Okay, now apply that across $10 billion in future revenue. Suddenly, that's the difference between profit and loss. That is powerful.
That would build some real conviction. Hard metrics. If you prove the mechanism works, the whole risk profile just changes completely.
Right.
And speaking of risk, we need to address the old ghosts of Opendoor 1.0 a lot more directly.
Yeah, that's a big one.
So, while the analysis report correctly identifies the high-risk, high-reward nature of the play, it has to systematically dismantle the specific historical bear case against Opendoor 1.0 to make the Opendoor 2.0 premise robust.
It really does. The current risk section is, it's just too generic. It focuses on a general housing market freeze.
Which is a risk for everyone.
Right, but it completely sidesteps the real weaknesses that scared everybody away in the first place. The intense inventory holding risk, the huge operational overhead, the constant cash burn.
This is just a massive oversight, especially when you're pitching a contrarian case. If you're going to argue that 2.0 is the antidote, you have to run directly at the poison that defined 1.0.
You do. Otherwise, you just leave this giant vulnerability for any skeptic to poke at. So, to really persuade people that the past isn't going to repeat itself, the report needs a dedicated section on this. It has to outline exactly how Opendoor 2.0, the expansion, the cost-cutting, is designed to neutralize those old financial vulnerabilities.
I see. Exactly what you're getting at. I mean, anyone reading this knows why the stock fell from $30 to $5. It wasn't just the housing market, it was the operational inefficiency.
It was the burn.
The burn. So the analysis could be so much stronger by detailing how that slashed overhead and the stabilized unit economics provide real insulation against a market dip. The argument becomes they can now maintain profitable unit economics even if volumes dip for a while.
That's a much stronger argument, because then you're not relying on a hot housing market forever. You're relying on efficient internal operations.
A much more defensible position.
And you've also got to draw a clear line showing how this rapid expansion to nearly every zip code is different this time.
Right, because last time, rapid expansion meant scaling overhead and just massively increasing risk in markets they didn't understand.
Exactly. Now, the writer can argue that because of the AI, the time to liquidate is shorter, the required margin per house is lower, all because the pricing is just that much better.
And to carry that forward a bit, look at how the report handles the negative PE ratio. It just says, smart money looks forward.
Which is a nice phrase, but it's not an analysis.
It sounds like hope. It's just hope. So you should proactively address this by actually calculating the break-even point. What volume, what unit economics margin do they need to hit to turn that PE positive?
I completely agree. That turns a philosophical point into a practical, trackable metric. Give the reader a milestone. Opendoor needs to process X transactions at Y margin to reach profitability.
Then people can track their progress against that goal.
It gives the whole argument teeth. It validates that forward-looking idea with actual hard numbers.
Absolutely. Which brings us to, I think, our final and maybe most crucial point, connecting that operational turnaround to the actual $10 price target.
The valuation bridge.
Current price to sales is like 1.08, which is low, but it never defines what the future multiple needs to be, or more importantly, why that multiple is even justified.
And this is where you define the reward. An investor needs to understand, okay, what PS multiple do we need to hit that $10 target, and why is that multiple the right one? They mention tech-driven platforms generically, but that's not enough.
No, you need to be specific. The suggestion is to clearly articulate the implied future valuation and then justify that re-rating. Use a comparative analysis to find a new valuation group for Opendoor 2.0.
So step one is making the math explicit.
Right. Calculate the exact market cap needed for the stock to hit $10. Given the current numbers, it's about $9.5 billion. That's the goalpost.
And once you have that market cap, you can define the PS ratio you need. On $10 billion in revenue, it looks like it's around 0.95 to 1.0, assuming the share count stays about the same.
But you can't stop there.
No, that's the mistake. You can't just assume the market will grant that multiple because they now say they're an AI company.
That's right. The justification is everything. You have to compare Opendoor's required PS to the average PS of the specific other AI stocks that the report claims it's undervalued against.
So you demonstrate the discount gap.
Exactly. You show that gap and you argue that it's going to close as they scale successfully. I mean, if other tech platforms traded a PS of, say, 3 or 4, then showing that Opendoor only needs a PS of 1 to hit $10, well, that makes the target seem conservative. It makes it highly defensible.
That calculation completely reframes the debate. It moves it away from, can they hit $10 billion in revenue, which is a big question about scale and market size, to, does a profitable, scaled AI platform deserve a PS of 1?
And that is a much easier argument to win.
Metrics to prove the AI works, and you've shown how the historical risks have been dealt with. It all ties together.
It becomes one cohesive thesis. Which brings us to the end of this critique. We've really identified 3 high-level opportunities here